What are the risks of early call features in fixed income? Imagine buying a bond expecting steady income over 10 years, only to find out it was called after 3. That's what early call features can do to your investment plan. These features allow the issuer to redeem the bond before its scheduled maturity date. While they might seem beneficial for the issuer, they can create some surprises for passive income investors. One major risk is reinvestment risk. When a bond is called early, you get your principal back sooner than expected. If interest rates have fallen since you bought the bond, you might have to reinvest that money at lower rates, reducing your future income. This can throw off your cash flow plans. Another issue is losing out on the interest payments you expected to receive. For example, if you bought a 10-year bond paying 8% interest and it gets called after 3 years, you miss out on the remaining 7 years of those payments. That can cut into your total returns quite a bit. The uncertainty of cash flows is another concern. Unlike bonds without call features, where you know exactly when you'll get interest and principal, callable bonds can be redeemed at any time after the first call date. This makes it harder to plan your income and manage your portfolio. Price behavior also changes with callable bonds. They tend to show price compression or negative convexity, meaning their prices don't rise as much when interest rates fall. This limits your potential for capital gains and makes the risk-return profile more complicated. Liquidity can also be an issue. If interest rates rise and the bond isn't called, you might be stuck holding a bond with a lower yield longer than you wanted. Selling it before maturity could mean accepting a lower market price, especially in a rising rate environment. Issuers often pay a call premium, an extra amount above the face value, to compensate for calling the bond early. While this helps, it might not fully cover the loss of future interest income or the reinvestment challenges you face. To manage these risks, it's wise to evaluate the bond's yield to call and yield to worst, which considers the lowest possible return if the bond is called early. Also, consider how likely the bond is to be called based on current interest rate trends. Diversifying your fixed income holdings by including non-callable bonds or bonds with less likely call features can help keep your income streams more predictable. Using callable bonds in a passive income portfolio requires caution because early calls can disrupt your cash flow and reduce income stability. Understanding these risks helps you make smarter decisions and better manage your fixed income investments for steady, reliable income.